My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Is it finally time to dust off the March playbook? Remember, this market got crushed in February as we realized the Fed wasn't done tightening. Then we had some banks collapse in early March, and we stopped worrying about the Fed because we figured the economy had to be weakening. That led to a wholesale shift into tech and out of finance. That turned into a launching pad for a multi-month run led by the mega-cap techs, especially the Magnificent Seven. So could a similar situation be coming together now after weeks upon weeks of pain?
The house of pain.
That may be what we saw today. Dow advancing 127 points, S&P gaining 0.81%, and the Nasdaq jumping 1.35%. It was a total shakeoff of the endless selling, and it really didn't start happening until later in the afternoon. While it's hard to believe that history could repeat itself, especially within 8 months, I got to say the setup seems remarkably similar, even if the starting point's very different. Yep, today we had a bit of a replay from March where newfound worries of a recession from demand destruction overwhelmed those who were fretting about an inflationary spiral of growth that seemed impervious to all the Fed's rate hikes. We just don't know if this is merely a one-day respite, though, or maybe the start of something bigger. Hey, come on, after the charnel house we've been through, a few hours of higher prices looms larger than maybe it should. It's been down so long it looked up to me today. To give you some context here, let's rewind the tape to the spring. In March, we had the collapse of a few highly visible banks, which set off a wave of fear that all of the regional banks might be going down like dominoes. That fear caused a collapse in Treasury yields, a run toward the most solvent companies, and an abandonment of any company that needed to borrow money to make the numbers, as a recession appeared imminent. As the mini-bank crisis dragged on, Treasury yields plummeted out of fear, and it seemed like the Fed might finally actually be done tightening. At the very least, they paused, and that was when the Magnificent Seven were born. And by the way, they were born out of desperation. The desperation of finding companies that had a lot of cash, didn't need to borrow. They were flush. Now, we all know what's happened since then. The economy didn't stall. In fact, it accelerated. The Fed started a new round of rate hikes, and it made clear that interest rates would stay, and we use this phrase over and over again, higher for longer. In response, a very quick but narrow bull market turned into a wide and horrifying bear market masked by tech as rates climbed ever higher, almost piggybacking off the rally in oil, the most visible sign that the economy had become a runaway train, with stocks looking like a bunch of school buses stalled on the bond market tracks. That is until today. See, today, oil, which had been hanging on by its fingernails after a brutal reversal 2 days ago that caused it to lose the $90 level, suddenly just got annihilated, falling more than 5%, falling more than 5% to $84 and change. This thing was 94 a couple days ago. It was a breathtaking decline brought on not by new supply from the Saudis or the Russians or even the Permian Basin, but by a collapse in demand. Specifically seasonal demand, the lowest in 25 years because of high prices at the pump. That's right, gasoline, it got too expensive. And that collapse caused long-term Treasury yields to plummet. Remember, it seems like there's less inflation. Very, very refreshing after watching them go up in a straight line since April, isn't it? Makes perfect sense, too. When long rates were soaring, we were constantly told the bond market was dancing to the tune of oil, because oil is widely seen as a barometer of economic strength. Today, we realize it's possible that the turbocharged oil rally may have been nothing more than a charade, a sham even, something brought on by a short squeeze that ended when oil couldn't take out 95, let alone $100. Sellers, actual sellers came to the market, and the refiners no longer seem to be begging for more oil because gasoline demand's been drying up at these high prices. It happened overnight. I mean, literally overnight. Now, there are a host of important indicators that are showing a much more mixed picture right now in the economy. We still have a robust job growth and business formation, according to John Gibson the other night that we had on, the CEO of Paychex, which is the largest payroll processor for small and medium-sized businesses that are doing so well. The manufacturing economy is certainly humming. Maybe that's that infrastructure money. There are parts of the country where companies still can't find enough people to hire. We know there's still inflation flaring in many places. Plus, between the Fed and the Treasury, way too many bonds are being sold, which sends those Treasury yields higher. Remember, it is still a market. There's too much supply. But for a brief moment today, we saw the division between the flush and the naked, and the money rushed to the companies that were flush while running away from those that needed to borrow. That's just like the March bottom. So was today a real repeat of March, replete with cascading bank stocks and the commodity stocks being clubbed into submission? I know you don't want to hear me say this, but we can't be sure. We have an auto strike that threatens to get out of control, with both sides hardening and billions being lost in this country because of the disruptions. Autos are a meaningful part of the GDP. They can't bring the economy down by themselves, but a strike can throw a lot of people out of work. We got housing numbers today that show the fewest mortgage applications since 1996. Hey, no kidding. Mortgage rates are almost at 8%. Of course that's going to matter. They're 3 and change about a year and a half ago. Housing's been a horse, but maybe not such a swift horse anymore. Are these symptoms of legitimate slowdown that would make the spike in long-term Treasury yields a one-time chance to lock in a much better rate than you've gotten if you want to invest since 2006? Or is it all fool's gold? Truthfully, again, you don't want to hear this, but I don't know. Isn't it better just to own that? I don't know. But here's the good news. We don't have to wait that long to find out. We don't have to wait. On Friday morning at 8:30, we get the September non-farm payrolls report. That's the single most important set of government statistics out there. And that's not just my opinion. Everybody knows it, including the Fed. Now, I have examined the long-term impact of every single report that comes out from the government, and the only one with true staying power to influence both stock and bond prices is indeed the non-farm payrolls report. If it shows more layoffs than expected and slower wage growth, it'll be hard to justify the relentless rally in interest rates. They'll seem like overdone, and the Fed's more likely to stay its hand. So what do we do? Well, because this stock market is as oversold as it was in March, and you know I care about that oscillator, and that's where we got to, when we had the fabled tech-led rebound, I certainly can't count on selling. You might be dumping your stocks in the beginning, but could be a better behaved bond market with the earnings reports that will most likely be pretty good. In particular, like in March, I think tech will shine, especially the semiconductor stocks that aren't connected to cell phones. Hey, somebody downgraded Apple today and the stock went up. What does that tell you? We've been buying some tech for my Travel Trust, which you can follow along by joining the CNBC Investing Club. Purchased some yesterday. At the same time, the economic weakness could change the Fed's approach is going to hurt plenty of companies. Here's the ones you got to think about: retailers, banks, and housing. In March, it was really just the banks. Now there are far more sectors that are, let's say, on the ropes. Last night I left here having watched videos of the usual billionaire suspects telling us on air the regular litany of negatives about the coming collapse of our great nation on the altar of the national debt. I watched hedge fund managers, many of whom were probably likely short bonds, telling us to get out of bonds now because it's too late, because bond prices are going to get crushed as interest rates soar because of hyperinflation. I saw moguls blast anyone with anything remotely positive to say, calling them out as charlatans, as naive bulls. I did not hear one person, certainly not one billionaire, say it was time to buy anything. Now, uniform negativity doesn't always mean we're about the bottom. Neither does this market's extremely oversold position, nor the decline in oil. But let me put it this way. We certainly have plenty of tinder for a rally. There are some Kingsfords lying around and maybe even a Duraflame or two. You get a weak payroll number on Friday, then I think we can get a narrow repeat of the rebound we saw in March. Bottom line, maybe all that needs to happen is for the frantic bond sellers to slow the pace of their sales. They don't even have to stop. They just have to be less desperate. Once that happens, we can finally focus on the myriad stocks that have been crushed for weeks now, many of which don't deserve it. No need to jump the gun, though. We'll find out soon enough. Zach in Texas. Zach!
Jimmy, how's it going, man?
Not bad, Zach. How about you?
Oh, it's a Monday. Having a case of the Mondays, but we'll get through it.
It's I think it's like Wednesday. That's all right. That's all right.
Oh, I might be wrong.
No, let me check. I got a bunch of Apple things here. Oh, Apple, sell, right? I mean, isn't that what they say? Go ahead.
Yeah, that's what it is. Look,
yeah,
man,
Apple's only down 30. Time to dump it, right? I mean, we got to get out of that one. What's happening?
Look, man, I've been trying to pull the trigger for years, but here's what I'm on. In the next 5 years, where do you see Target stock going?
5 years. Wow. Guy wants a 5-year Target call. Okay, I think the Target is a very good company, but I only really like it in the retail business. I like TJX. I like Costco. Okay, they're good. And I like the Amazon, and I'm willing to throw in Walmart because I'm a forgiving judge of retail. All right, but whoa, nice shot. Hey, take that. Now, it might be too early to tell, but if the bond market can stabilize from here, we may finally be able to focus on some of the stocks that have gotten hammered over the past few months. On Mad Money tonight, One Running hosted an Investor Day earlier today, highlighting how many shoes my wife has bought in the closet. No, a host of long-term growth targets. And with the stock dropping the announcement, I'm running through the latest with the company's top brass. Then breaking up is hard to do unless you're Danaher. I'm taking a closer look at the story after the company spun off its Environmental Applied Solutions division. Hey, you got some interesting stocks here. And this year's been volatile year for the beer stocks. But could a stock like Molson Coors buck the trend? I'm checking in with the company's CEO. So far, I like what I see or taste. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.